Bitcoin and Ethereum, the two biggest names in crypto. But which one is the better investment in 2026? Well, before you could decide on whether you want to invest in Bitcoin's BTC or Ethereum's ETH, pronounced ETH, you need to understand what each one actually is, because both were built for fundamentally different reasons. As you might know, Bitcoin was created in 2009 by an anonymous person or group under the pseudonym Satoshi Nakamoto. Satoshi's original goal was simple: create a peer-to-peer digital cash that didn't require a bank or government to function. Over time, though, that vision has evolved. As amazing as Bitcoin is, it ironically failed at its original goal of becoming a viable peer-to-peer money system. To be clear, Bitcoin can still be used in that way, and by many metrics, it would still be a better monetary system than what we have today. But it's not exactly the fastest network around, and the fees are simply too high to make it a real alternative. Today, people treat Bitcoin less like a currency and more like a savings asset. Its properties have earned it the nickname, quote, digital gold, and for good reason. We'll come back to why that is later. For now, just know that this comparison captures how most serious investors actually use it, as a store of value outside the traditional financial system. Ethereum, on the other hand, was created in 2013 by Vitalik Buterin and was officially launched in 2015. Unlike Bitcoin, the team behind Ethereum is publicly known, and Vitalik is just one of 8 co-founders of the project. While Bitcoin aimed to become a new monetary system, Ethereum's ambition was entirely different. Where Bitcoin's scripting language is deliberately limited to keep things simple and secure, Ethereum introduced something called smart contracts, which are basically self-executing bits of code that run automatically when preset conditions are met. Smart contracts were an absolute game changer, and I don't say that lightly. That's because they completely transformed what a blockchain could do, and what the crypto industry has to offer. Instead of just moving value from A to B, Ethereum allows you to build apps on top of its blockchain. These apps can include lending platforms, exchanges, stablecoins, insurance products, games, and so much more. More importantly, though, smart contracts are the backbone of decentralized finance, or DeFi. And for many investors, be they retail or institutions, DeFi is arguably the most important aspect of the entire crypto industry. Like I said, game changer. Choosing between Bitcoin and Ethereum is a bit like asking if you'd rather invest in digital gold or a stake in a decentralized app economy. They're both mammoth projects that occupy very different lanes. Neither is trying to beat the other at its own game, and understanding that distinction is the starting point for every crypto investor. And by the way, if you want to keep up with the latest Bitcoin and Ethereum news, you could easily stay up to date by getting our weekly newsletter sent directly to your inbox. That's where our research team breaks down the biggest stories shaping the market and highlights the key catalysts for the week ahead. And best of all, it's completely free. So what are you waiting for? Just sign up using the link down below or scan the QR code on the screen. Now, let's talk about why you may want to invest in Bitcoin. Since we already have an overview of what Bitcoin and Ethereum are, let's zoom in on both of them to get a better understanding, starting with Bitcoin. In a nutshell, Bitcoin's investment case comes down to 3 things: scarcity, simplicity, and security. The scarcity is baked into Bitcoin's code, and is where the digital gold narrative comes from. Gold has a finite supply, and this scarcity is much of what gives it value. Similarly, there will only ever be 21 million BTC, and just over 20 million of those have already been mined into circulation. This means that there's not much room for BTC supply to be inflated. Even then, the rate at which new coins are mined, that is, created, gets cut in half roughly every 4 years in what's called the halving. The most recent halving happened in April 2024, bringing the reward for mining a new block down from 6.25 BTC to 3.125 BTC. Naturally, this means the next halving will happen sometime in mid-2028. Just like BTC's capped supply, halving events are baked into the code, and that's why Bitcoin is described as disinflationary. Its new supply shrinks on a fixed, predictable schedule. Nobody, not even a government or central bank, can override it. Simplicity is another important aspect. Bitcoin is the first successful decentralized cryptocurrency, and is undeniably one of the most innovative technologies of today. However, it's not a complex beast like Ethereum. It holds value on a decentralized network and has an impeccable security track record, but without all of the bells and whistles of smart contract functionality. Still, this simplicity has made Bitcoin the easiest entry point for investors exploring crypto for the first time, since they don't really need to understand things like DeFi, smart contracts, or Layer 2 networks. For most people, BTC is simply an investment, something they can hold long term, comfortable in the knowledge that BTC is the best performing asset of all time. And, of course, there's the most important aspect of all, security. The Bitcoin network is maintained by nodes distributed around the world. Nodes are computers that store a copy of the entire Bitcoin blockchain and independently verify all transactions according to the network's rules. They check that transactions are valid and that nothing shady is going on, like double spending or creating BTC out of thin air. Importantly, though, any node or miner, anywhere in the world, can take part. That is what makes Bitcoin the most decentralized and therefore the most secure network in existence. To corrupt it would require what's known as a 51% attack, where a bad actor controls a majority of the network's mining hash rate. To corrupt it would require what's known as a 51% attack, where a bad actor controls a majority of the network's mining hash rate. Pulling that off would demand an unfathomable amount of computing power and capital, effectively making a 51% attack impossible. All of this makes Bitcoin arguably the most credible and effective monetary system on Earth, and is why Bitcoin has seen massive institutional adoption. Since January 2024, US spot Bitcoin ETFs, exchange-traded funds that hold actual Bitcoin and trade on regulated stock exchanges, have made it easy for everyday investors and big institutions to buy indirect exposure to real BTC. And make no mistake, the demand for spot Bitcoin ETFs has been so insane that they've also been one of the fastest growing ETFs ever created, much like how actual BTC is the world's best performing asset. As I record this, those spot Bitcoin ETFs now hold over $106 billion in assets under management, or AUM. BlackRock's IBIT alone accounts for roughly $66 billion of that. Corporate treasuries have also accumulated BTC at an extraordinary pace. Michael Saylor's Strategy, formerly MicroStrategy, is the biggest example, holding over 843,000 BTC as I record this. That's 4% of the total supply that will ever exist. And since the April 2024 halving, corporate buyers have collectively been acquiring BTC at roughly 2.8 times the rate of new coins are mined. That's an unprecedented supply squeeze. For anyone wanting long-term exposure to crypto with the least amount of headaches, Bitcoin is the go-to starting point. It has the strongest brand recognition in the space, the deepest liquidity, and a narrative of hard, scarce digital money that's easy for anyone to understand. And that narrative has pushed BTC's price up to new all-time highs in every single crypto market cycle so far. But what about Ethereum? Well, if Bitcoin is a bet on crypto as a new money system, Ethereum is a bet on crypto and blockchain technology actually being used. Think of Bitcoin like a savings account and Ethereum as the economy. It's not the perfect metaphor, but we're keeping things simple here. Now, while Bitcoin uses a proof-of-work consensus mechanism, which involves miners using energy-intensive hardware, Ethereum uses a proof-of-stake consensus mechanism, which doesn't require any specialized hardware. Basically, this means that Ethereum is secured by validators rather than miners, who gain the ability to authorize transactions by locking away or quote-unquote staking a minimum of 32 ETH to become a validator. Unlike BTC, investors don't primarily buy ETH as a store of value. Instead, the bull case for ETH is about utility and the compounding value of being the infrastructure layer for a financial ecosystem built on top of it. As we touched on earlier, Ethereum's smart contracts enable functionality that Bitcoin really just can't support. And its first mover advantage is why it remains the dominant force across most sectors of the crypto industry. This is especially true in DeFi, which you'll recall is one of the most important things crypto has to offer. Ethereum's DeFi dominance is huge. There's over $82 billion in total value locked across DeFi, and more than 52% of that sits on Ethereum, at around $43 billion. And that doesn't even include Ethereum's Layer 2 ecosystem, but more on that later. It's a similar story with stablecoins, which are arguably crypto's best product. Just over 50% of all stablecoins live on the Ethereum mainnet. These aren't speculative metrics. They reflect real capital sitting in real protocols that people are actively using. Ethereum's ETF story is also developing. US spot Ethereum ETFs first launched in July 2024, several months after the spot Bitcoin ETFs. To say they didn't cause the same buzz as the spot Bitcoin ETFs would be an understatement. But overall, they've largely been a success story. Today, spot Ethereum ETFs hold more than $13 billion in AUM. Perhaps unsurprisingly, BlackRock leads the pack again with its ETH-A fund, which holds over $6.4 billion in AUM. Notably, investors also have the choice of staking Ethereum ETFs. Staking ETFs are products that allow investors to earn a yield based on Ethereum's native staking rewards, which is around 3% as I record this. These products have created a new category of institutional demand for ETH, which can't be matched by spot Bitcoin ETFs, since Bitcoin can't be staked. Now, for those unfamiliar, tokenization means turning real-world assets, like property, bonds, or invoices, into digital tokens on a blockchain. And this is a big deal for Ethereum. This makes real-world assets easier to trade and split into smaller pieces, which isn't always possible with the underlying asset. It also makes traditional assets more liquid and accessible, while reducing paperwork and middlemen, making transactions faster and cheaper overall. And these tokenized real-world assets, or RWAs, have seen insane levels of demand. For instance, BlackRock's BUIDL fund, which tokenizes US Treasury exposure, launched on Ethereum in March 2024 and quickly became one of crypto's most important tokenized RWAs. Today, it holds a massive $2.5 billion in AUM. Another major asset manager tokenizing real-world assets is JP Morgan. In December last year, it launched its first tokenized money market fund called My On-Chain Net Yield Fund, or MONEY for short. Today, that money fund holds just over $100 million in AUM. And it's worth noting that stablecoins can be categorized as tokenized RWAs. That's because they are tokens pegged to the value of real-world assets, and they're typically backed overwhelmingly by bonds. In most cases, this is the US dollar and treasuries. But there are also stablecoins for other currencies, like the euro or the British pound, and there are even stablecoins pegged to the price of gold. Whatever the case, the point is that Ethereum accounts for the lion's share of the RWA market, being home to over 55% of all tokenized real-world assets. Today, that's valued at a mind-melting $19 billion, if you exclude stablecoins. For an investor who believes that crypto will become a genuine layer of global financial infrastructure and not just a speculative asset class, Ethereum is the more direct bet on that outcome. Now that you know why Bitcoin and Ethereum are so great, you're probably ready to invest in either BTC or ETH. The thing is, nothing in investing comes without its trade-offs, and neither Bitcoin nor Ethereum is an exception. Bitcoin's trade-off is pretty simple, and that's, well, its simplicity. While Bitcoin's simplicity is certainly a positive feature, this does also mean that Bitcoin can do far less than most crypto projects. Bitcoin may have its own layer 2s that bring a little extra to the table, but there's no real DeFi on Bitcoin's base layer, no stablecoins, no token ecosystem in any comparable sense. Bitcoin's value is almost entirely reliant on its store of value thesis. But if for some reason that narrative came under threat, say a superior alternative to digital gold emerged, there's no underlying app economy to fall back on. In this sense, Bitcoin's simplicity is both a blessing and a curse. For what it's worth, though, the chances of another asset emerging as a better version of digital gold and then winning over investors, institutions, governments, and corporations to replace Bitcoin, that is basically zero. Ethereum's trade-offs, on the other hand, are more complex. ETH has more potential sources of value, from transaction fees, staking yields, DeFi activity, tokenization, and more. However, more complexity also means more things that can go wrong, and more genuine competition. Solana is the clearest example. It's faster and cheaper than Ethereum, and this has helped it carve out meaningful market share in areas like DEX trading volume and retail DeFi activity. And more importantly, Solana is easier to use since there's no layer 2 ecosystem adding to its complexity. Ethereum, on the other hand, is practically reliant on its own layer 2 ecosystem. For anyone unfamiliar, layer 2 blockchains like Arbitrum and Base are separate networks that take transactions from the main chain, Ethereum, bundle them together, then process that bundle as one transaction. The data from that processed transaction is then posted back to the mainnet. But why is that needed? Well, it's simple. Ethereum itself isn't particularly fast, and the fees are higher than most of its competitors. When the network gets congested, the network slows down to the point it becomes a pretty miserable experience for users. And the spike in transaction fees certainly doesn't help. Layer 2s address these concerns, allowing for much faster transactions at just a fraction of the cost. The problem, though, is that this also introduces fragmentation. That's because liquidity is spread across many different environments, rather than sitting in just one unified place. There's also the issue of narrative clarity. Bitcoin has a clear story, but people still debate what Ethereum's narrative actually is, given how broadly it influences the crypto industry. While some consider that as a strength, most people agree that lack of simplicity is a real weakness. Institutions and retail investors often struggle to explain Ethereum in a single sentence, and that matters for adoption. And on top of that, ETH supply isn't capped like BTC's. Instead, part of every transaction fee is burned, that is, permanently destroyed. When network activity is high, this can make ETH deflationary, but when usage drops, less ETH is burnt. This could be the difference between ETH being deflationary or an inflationary asset. As I record this, ETH is actually inflationary, albeit only slightly. So, while BTC's supply is capped at 21 million, there's no supply cap on ETH, and there's no halving events or anything similar to reduce the rate of inflation. ETH's supply dynamics fluctuate over time and is dependent on how much the network is being used. This ties ETH's economics directly to adoption in a way that Bitcoins do not. As you can see, neither BTC or ETH are truly perfect, and neither asset is, quote, better than the other. Both have different narratives, different supply dynamics, different strengths, and different weaknesses. And for that reason, both assets occupy different roles in an investor's portfolio. So, where does this leave you as an investor? Is BTC right for your portfolio, or are you better off with ETH? Well, here's the key thing to keep in mind. Even though they're the top 2 cryptos by market cap, Bitcoin and Ethereum aren't really rivals. They're 2 different bets on 2 different ideas. And the right choice for you likely depends on what you believe. To refresh your memory, Bitcoin is a reserve asset. Its value proposition is that it's the most credible form of digital scarcity that exists. Simple, predictable, globally recognized, and now accessible through regulated financial products in a way that's brought over $100 billion from institutional investors. Not bad for a product that's been around for just over 2 years. If your view is that the world will eventually lose faith in governments and central banks and seek out a decentralized, non-government store of value, then BTC is a clear bet on that thesis. It doesn't require crypto to, quote, work in any application sense. It just requires that scarcity and trust continue to matter. There's a reason why almost every person who's invested in crypto holds at least some BTC in their portfolio. Conversely, Ethereum is a platform. In its earlier years, it's often described itself as a global, decentralized computer. Although this exact phrasing has fizzled out over the years, since some people found the concept a bit too confusing. Instead, Ethereum is best understood as a decentralized execution platform, powering a huge range of applications and use cases through smart contracts. ETH's value is derived from what runs on top of Ethereum, the DeFi protocols, the stablecoins, the tokenized RWAs, and the decentralized applications. If your view is that blockchain technology will play a critical role in the global financial system, then Ethereum is the more direct exposure to that outcome. And it's worth noting that the risk with Ethereum is proportionally higher, and so, in theory, is ETH's upside. So, for anyone wanting simple, long-term crypto exposure with minimal ambiguity, BTC is the more straightforward investment choice. Its track record is longer, its narrative is simpler, and the recent wave of institutional infrastructure, like ETFs, corporate treasuries, and growing regulatory clarity, has reduced many of the risks early investors faced. although there's still room for improvement on the regulatory front. For anyone who enjoys researching to get a better understanding of what crypto is capable of, or genuinely believes crypto will become revolutionary for financial infrastructure rather than just a place for hyped-up speculation, then ETH makes a compelling case. That's simply because Ethereum is the platform that most of the infrastructure is currently being built on. But of course, there is a third option. Most experienced investors don't just buy BTC or ETH. They hold both. Not because they can't decide, but because Bitcoin and Ethereum are both genuinely awesome cryptos answering different questions. The wisest investors know how to diversify their portfolios, at least a bit, and by scooping up both BTC and ETH, basically invested in the entire crypto ecosystem. And with that, it's now time to hear from you. Are you a Bitcoin maxi, or are you bullish on Ethereum's future? Do you think BTC and ETH's price will go up or down in the months ahead? Or are we destined for lots of sideways price action? Let us know your thoughts in the comments down below because we would love to hear from you. If you want to see why BlackRock thinks that BTC will go to $1 million, well then you could check out our video on that right over here. And if you want to learn more about how to use Ethereum without getting rinsed in fees, then check out the video that we made on that right over here. Thank you all so much for watching, and I'll see you again very soon. This is Lewis, over and out.